Hey guys, welcome back to Nifty Invest. In this video, Jim Rickards discusses the relationship between interest rates and the business cycle and the different indicators that suggest an economic downturn may be on the horizon. He notes that interest rates are a lagging indicator and that business owners, entrepreneurs, and medium-sized businesses are often the first to notice when a recession is imminent. He also points out that while the stock market is predicting a soft landing, the bond market is signaling that a recession is coming, and that the inversion of yield curves is a particularly worrisome indicator. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
The interest rates are a lagging indicator. Everyone's like, well, how could interest rates be going up if we're in a recession? The answer is, as you get closer to recession, who figures it out first? Well, the Fed figures it out last. They're usually the last to know. Wall Street is second last to know. The people who figure it out first are actual business people, entrepreneurs, restaurant owners, dry cleaners, taxi drivers, or even medium-sized businesses. They see it. If you're in the trucking business, it's real time. If inventories are sky high and new orders are being slashed, you're not moving anything by truck. So there are certain businesses that are concurrent. But the stock market is saying, the Fed's raising rates, inflation is coming down, but we think they're already at the terminal rate. But not only that, we think they're going to get the memo that the Fed will figure that out before they get to 5.25, before they raise rates in May, maybe even March. Maybe they're done. And because of a recession, this is the soft landing Goldilocks scenario where the market's right, the Fed's wrong, but the Fed will realize that the market's actually right and cut rates, and if you're going to cut rates, buy stocks. That's like Wall Street always ends every analysis with buy stocks. If you listen to Michael Burry, Jeremy Grantham, Charlie Munger, these people have been around and they run, hundreds of billions, and they're saying the same thing. So Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's a triple greatest bubble of all time times 3, in the sense that it's real estate, stocks, and other asset classes. So I do, that is my view, but it's shared by a number of other analysts. 1929, everyone's like, October, I think 18th or 19th, it was late October 1929, the stock market fell 22% in 2 days. It wasn't one day, it was like 12% one day, 11% the next day, so 23% over 2 days. But that wasn't the crash. That was the beginning of the crash. This Dow Jones fell 82% from top to bottom. Now, it took 3 years. It bottomed in June 1932. Started in October 1929, so not quite 3 years, but that fell 82%, and that happened. So we're down. Nasdaq's down, bounced back a little bit in recent days, down close to 30%. Down, the S&P down over 20%. We're in bear market territory, but that's just the beginning. That's not what a full bear market, market adjustment looks like in the face of the kind of recession that I expect.
Jim Rickards explains that interest rates are a lagging indicator, and that people like to question how they could go up if we're in a recession. However, as we get closer to a recession, business people like entrepreneurs, restaurant owners, and taxi drivers are the ones who figure it out first, not the Federal Reserve or Wall Street. The stock market might say that the Federal Reserve is raising rates and inflation is coming down, but it might not be the case.
The bond market is telling a completely different story, by the way, and this is a little more esoteric, but if you look at yield curves, look at the Treasury yield curve, Euro-dollar futures yield curve, German bunds, they're all inverted. Now, inversions happen, just meaning the longer term rate is lower than the short term rate. Now, this is in the Treasury yield curve. They're inverted from 1 month to 20 years. It's not like, people talk 2s and 5s and 5s and 10s. And 1 month, a 1 month bill is yielding more than a 20-year note. Okay, that's inverted across the entire yield curve. Eurodollar futures, same thing. The inversion kicks in. It doesn't kick in immediately because the Fed does control very short-term rates and they're raising them, but the kink kicks in like in March 2023, which isn't that far away. And bunds have never been inverted. They are now. Even the inversions that have happened in the past, which are rare, have not been as steeply inverted as they are now. We're seeing something globally we've never seen before. And it is the best single indicator of a recession. The last time we saw anything like this was in 2007, just ahead of the 2008 financial catastrophe. So the stock market's saying it's all good, Goldilocks, soft landing, Fed's going to get the memo, they're going to cut rates, the pivot, and buy stocks. The bond market is saying, no, this is bad and it's going to get worse, and it's actually too late for the Fed to do anything about it. But as far as banking and credit is concerned, what happens is if you're a business person and you see business heading down, fewer customers, whatever, you go out and borrow all you can. You're like, hey, there's a really bad recession coming. I better, if I got lines of credit, I'm going to use them up now. I don't want my bank changing the terms. I don't want material adverse average change clauses kicking in. Instead, I'm going to borrow everything I can. And that creates a demand for funds and interest rates go up. And then the recession hits and the bankers go, what's going on? Credit losses start going up. And then they just turn off the spigots and they raise standards. They stop doing loans. And then interest rates will start to come down. But interest rates peak after the recession has already begun. So interest rates may not have peaked yet. I mean, even the Treasury market. So that's not unusual.
Jim Rickards believes that we are in a triple greatest bubble of all time that includes real estate, stocks, and other asset classes. The bond market is telling a completely different story and indicating that we might be headed for a recession. This is the best single indicator of a recession, and the last time we saw anything like this was 2007, just ahead of the 2008 financial catastrophe. The stock market believes that it's a Goldilocks soft landing, but the bond market is saying that it's going to get worse, and it's actually too late for the Fed to do anything about it.
So stock market's telling us Goldilocks, bond market's telling us, here comes, Hurricane Mitch or whatever. And then there's what I call the reality. The standard definition of a recession is 2 consecutive quarters of declining GDP. There are a few more bells and whistles having to do with unemployment and a few other things, but that's the rule of thumb. So based on that, and based on the best available estimate for a second quarter, likely to be accurate, we're in a recession today. Now, it's not severe, but that's like saying I'm in bed with pneumonia, but I'm not dying. Well, okay, but we're in a recession right now. The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed has probably over-tightened. That means they're going to make it worse. They're going to make the recession even worse. In other words, if the Fed cuts rates, which they may, the pivot may be real. It's not because they engineered a soft landing and Goldilocks and everything. Oh, that's just right. It's because they screwed up as usual, as they've been doing since 1913. And we've seen this movie before. This is exactly what happened in 2018. I mean, the Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre. And after most of the 20% collapse had already happened, they tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market, this whole, Bernanke put and Greenspan put and all that. That's not how it works. They don't care that much about the stock market level. Here's what they do care about. They care about disorderly markets.
What do you think about this video? Comment down below. Don't forget to like and subscribe. This is Nifty Invest. We'll see you in the next video.
The narrow focus I'd like to start with, since it's the topic of the day, is the dollar And, I'm going to throw red meat to the wolves here by citing a headline across Bloomberg earlier from Larry Summers talking about how the dollar can continue to move higher because the U.S. has all these great fundamental advantages. This comes, 24 hours after another Bloomberg headline talked about the unstoppable strength in the dollar. So there's the red meat for you, and I'll let you gnaw on that for a little bit.
Well, it may come as a surprise. I think Larry Summers was half right, and I've met him a number of times. He's a brilliant guy. I almost always agree with his analysis and then disagree with his policy. So I always have to stop halfway with Larry Summers. Like, good analysis, Larry, but you're going the wrong way. But yeah, I think he's right that the dollar will get strong. Is probably correct. Also, where I disagree, and this is critical, is the reason why. The dollar is getting stronger for some very bad reasons, meaning bad in terms of the macroeconomy, what probably lies ahead, what is probably telling us. So let's just maybe step back and not be Larry Summers for a minute, but just be everyday investors and asset allocators and analysts and say, and I hate to use the word conundrum because Greenspan used it, but conundrum is a fancy way of saying I don't really understand what's going on. But this is a conundrum for a lot of people because they look at it, the U.S. objectively, okay, our debt to GDP ratio is over 130%, highest in U.S. history. Tons of research coming from obviously Ken Rogoff, but really Carmen Reinhart, Vincent Reinhart, and others, but many others, not just them, that says at those debt to GDP ratios, you can't grow. You can maybe refinance and muddle through, but it always ends either in default, which is unlikely because we can print the money, that much is true, or extreme inflation where here's your $1 trillion back, good luck buying a loaf of bread. So we'll see how that plays out. But the way it's playing out in real time is that the U.S. Economic growth is incredibly weak. So we've got sky high debt to GDP ratio. By the way, when you look at other countries in the world, you say, okay, who's at that lunch table, 130%? The answer is Lebanon, Greece, Italy. Those are your lunch partners, so to speak. And
this is like the scene from Animal House. Would you like to meet Clayton, Jagdash, and Muhammad?
That's a good comparison. Economic growth is weak. We're in a recession. I don't care what Janet Yellen says. I don't consider her expert on the topic, but we've had our 2 consecutive quarters of declining GDP. Like it or not, that's the definition of recession. The fact that the National Bureau of Economic Research, which is a private group, by the way, but they're the recognized referees on recessions and recoveries, the fact that they haven't said so doesn't mean anything because they never do say so until 9 months or a year after it happened. And for that matter, most recessions are 2 quarters, some 3, some have been longer, but most recessions are a couple of quarters. The National Bureau of Economic Research usually declares a recession after it's already over. Like it started, it happened, it's over, we're in recovery. And they go, oh, by the way, we had a recession last January. Okay, so they'll probably get back to us, I would bet heavily after the election. But we'll hear from them at some point. But we're in a recession now, and people say, what about the third quarter? And it's interesting because I do put some weight on the Atlanta Fed GDP now. I do think it's a very good tool. They miss sometimes, they're not always accurate, but it's the best tool out there. But very few people understand their statistical technique. Because what Wall Street does, you get a whole bunch of components for GDP, and they come in at different times with different lags, and you add them all up and you get GDP. And what Wall Street does, they look at what they have and they project all the rest based on regressions and correlations, which don't necessarily hold up. But they say, okay, here's what we think. Here's our forecast for third quarter GDP based on projections of what we don't know. Atlanta doesn't do that. Atlanta takes what we do know, hard data, and they ask a different question. They say, what would GDP be now if this was all we had? And they put out a number. But they don't guess at the stuff they don't have. And it fills in as it goes along. So it's much more Bayesian in that sense. But because of how the data comes out, the time sequence to which the data comes out, it typically fades as the quarter goes on. It's not because they're using bad methodology. It's just because that's how they do it. And so just in the last week, 9 days or so, it went, everyone was cheering. I think with September 1st, it was 2.3%, maybe a little higher, but about 2.3%. 2 days later, it was 1.6, and now it's down to 1.3. So it's following that pattern. I would expect by the end of September, we still got 3 weeks to go, given what I said about how it fades, it doesn't have to be negative, but it could very well be negative, maybe 3/4 of decline in GDP. But whatever it is, it's going to be weak. So if it's positive, 2/10 or 3/10, I mean, that's okay, but you're still a rounding error away from recession. It doesn't mean the problem's over. So debt to GDP is sky high, economy weak at best, probably had a recession in the first half. Maybe that's continuing. People talk unemployment close to an all-time low, went up a little bit in the last report. Yeah, but even at 3.5% or so, that is extremely low. I mean, I go back to the 1960s, and that was low by the measures of the 1960s. But that completely ignores probably 8 to 10 million Americans who were perfectly able of having jobs and working, prime age 25 to 54 years old, who are not in the workforce.
Yeah.
That measure is picked up in labor force participation rate, which is low. I mean, that peaked around 70% in 2000, up from the 1970s, and that was women coming into the workforce and other factors. But now it's down to around 62% and change. It ticked up a little bit in the last report, but it's still extremely low. It's never 100. I mean, there's always, you could be a homemaker, a student, they're retired, early retirees. There are a lot of reasons people aren't in the workforce, but not taking 10% off or 14% decline from the starting place in over 20 years. That's so if you throw those people into they're not called unemployed because they're not looking for jobs. But if you threw them in, unemployment would be closer to 10%, which is a recession or a depression level, actually. And I could go on, but the point is there are all kinds of signs of weakness. So, if we have the deficit, where the baseline deficit is $1 trillion. That's before an extra $2 trillion for Trump's COVID relief, an extra $3 trillion for Biden's COVID relief, if you include the ludicrously named Inflation Reduction Act,
Right.
and the American Rescue Act and the Infrastructure Act. Call it what you want. It's still $3 to $4 trillion.
Yeah.
2 for Trump. That's 6 on top of 2 baseline. That's $8 trillion in 2 years. So your deficit's out of control, and your trade deficit's out of control. So what's not to like? And yet you look at all that and say, "What? You kidding me? I mean, get me out of the dollar. Go get anything else." Why is the dollar so strong? And the answer is, for this, you have to go behind the curtain. You have to look into what's called the plumbing of the international monetary system. And I had a discussion, and this goes back, this is 1980. So I'm an young, up and coming vice president of Citibank. That's back in the days when it was a bank before they turned it into a hedge fund. So I'm like a 27 or whatever, a 28 maybe year old lawyer. But I'm talking to Walter Wriston. It's a one-on-one conversation. He was, for those who don't know the name or don't recall, he was probably the second greatest banker of the 20th century after Pierpont Morgan. So I'll give Morgan the prize, but he left around 1910. And Wriston was the inventor of the Eurodollar. The negotiable certificate of deposit. Eurodollars are around a little bit earlier, but he took the CD that was your interest in the Eurodollar and made them negotiable and tradable. So I'm having a conversation with him, and I had just seen this movie, which I highly recommend. Chris Christopherson, Hume Cronin, and Jane Fonda. It's called Rollover, and it's again 1980, but all-star cast. Yeah, I got a murder mystery, a little sex thrown in, but it's basically about the collapse of confidence in the U.S. dollar. And Hume Cronin plays the Walter Wriston part, and basically the idea was remember this is during the Arab oil embargoes and the Iranian oil embargo, and price of oil quadrupled in 8 years and all that. So the theme was the Arabs are taking the money out of the banking system and buying gold, and they're stashing the gold away. And this is the collapse of the financial system. And that was sort of the plot. So I said, Mr. Wriston, what about that? Everyone took their money out of the system and bought gold. Wouldn't that collapse the system? And he looked at me like I was a new kid on the block, which I was. And he said, well, what you have to understand is that you can take your money out of the bank and you can buy gold. but the person who sold you the gold got the money and they put it back in the bank. So it doesn't go anywhere. It's a closed circuit. And of course, now I'm like, oh yeah, you're right. Of course, he's right. And he said, so the stability of the system doesn't depend on who sells what for dollars. Yeah, it affects exchange rates a little bit and interest rates with the price of gold. But he said the money always, it can't literally disappear. It has to go back into the system. It's a closed circuit. And of course, that's how the Eurodollar system works. The supply chain was breaking down before COVID. Now, of course, COVID made it worse, yes. And the war in Ukraine made it worse yet, yes. But this really started with Trump's trade war in 2018. So that, like I said, there's a thread that runs through all these things. So not to throw out my hands, I'm not going to do that. But when you ask me that, I'm thinking, well, you know, talk about China, Ukraine, supply chain, Biden, they're all a big deal. If you know, in terms of tragedy, probably the war in Ukraine is the most important because it's highly, highly significant economically and strategically. But of course, it's a human tragedy going with it. You know, if Chinese real estate implodes, okay, there's some hardship here and there, but it's not like people being killed or maimed or forced into refugee status. And that is part of what's going on in Ukraine. So that's probably the biggest single one, but I wouldn't miss the fact that all these learned about inflation, but there's a big backstory there. But I always say when it comes to your own money, everybody has a PhD in economics. You don't need Larry Summers to tell you what's going on with your budget and your, you know, ability to feed your family or keep a roof over your head. So people get inflation. One of the reasons it's so politically toxic is because it's unavoidable. You can't fudge it. You can't spin it. It's like, hey, if I used to fill up my Ford F-150 truck for $50 and now it's $125, A, you get it. It's right in your face. And B, that's $75 that you don't have to take your spouse out to dinner, you know, buy a new jacket or whatever. So there's kind of demand destruction at the same time you're spending more money on the one thing you can't do without. So people get it. But then from there, the question I get the most is, hey, Jim, is this going to cause a recession? Are we going to have a recession? And as recently as a few months ago, I would say, yeah, I think so. You can see it coming late this year, early next year. Now I say, we're in a recession. I mean, it's not coming, we're in it. And there's data. I never make statements like that, Brian, without supporting it. So the standard definition of a recession is 2 consecutive quarters of declining GDP. There are a few more bells and whistles having to do with unemployment and a few other things, but that's the rule of thumb. So based on that, based on the best available estimate for a second quarter, likely to be accurate, we're in a recession today. Now, it's not severe, but that's like saying I'm in bed with pneumonia, but I'm not dying. Well, okay, but we're in a recession right now. And there's a lot of whistling past the graveyard. I mean, the stock market is still greatly overpriced. There's still, the buy the dips mentality hasn't gone away. It's still there. You got people like Jim Cramer yelling, buy Netflix or whatever. And there's institutional support. There's momentum trading. Of course, 95% of the trading is by robots. So you got to reverse engineer the 27-year-olds from Bangladesh who don't get out much. They're the ones really writing these algorithms. I mean, brilliant engineers, but you'd have to show them around Wall Street. So all that's going on. So we haven't really seen the market collapse, stock market collapse that I would expect in association with a severe recession has not happened yet. This is just going to play out. It'll get worse as the year goes on. All
right. So you're expecting a major correction in stock markets on the back of a recession.
Alone. I mean that is my expectation. I have my own models and I look at it closely. But if you listen to Michael Burry, Jeremy Grantham, Charlie Munger, these people have been around and they run hundreds of billions, and they're saying the same thing. So, so every now and then someone will throw some statistic at me and I go, how long is your time series? And I go, oh, we took it back 5 years. I was like, talk to me if you've done it for 100 years, because that's a little more meaningful. But Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's a triple greatest bubble of all time ×3 in the sense that it's real estate, stocks, and other asset classes. So yeah, I do. That is my view, but it's shared by a number of other analysts.
And that would mean like S&P coming off another 20, 30%?
Yes. And again, you have to remind people. 1929, everyone's like, yeah, October, I think 18th or 19th. It was late October 1929. The stock market fell 22% in 2 days. It wasn't one day. It was like 12% one day, 11% the next day. So 23% over 2 days. But that wasn't the crash. I mean, that was the beginning of the crash. This Dow Jones fell 82% from top to bottom. Now, it took 3 years. It bottomed in June 1932. Started in October 1929, so not quite 3 years. But that fell 82%. And that happens. So yeah, we're down, NASDAQ's down, bounced back a little bit in recent days, down close to 30%, down the S&P down over 20%. We're in bear market territory, but that's just the beginning. That's not what a full bear market, full, market adjustment looks like in the face of the kind of recession that I expect.
Talk to me about inflation, because I was looking at some of the inflation numbers, and you have to go back to the 80s to see anything that's approaching double digit. I remember being just a kid hearing about double digit inflation. I could kind of remember the gas pumps, the lines at the gas. It's like a distant memory of me in the 70s. But how do you talk to younger people these days about what inflation is or it means? Because I don't think people really grasp what it actually means to your savings or to the economy in even a medium term.
Well, that's exactly right, Brian. And if you, you're a little younger than I am, but I lived through it. I started my career in banking in 1976, and I remember my wife and I used to kid each other. She was in advertising, I was in banking, and the inflation was so bad, you'd get a raise every like 4 or 5 months, and you didn't have to ask. They would just give it to you because they knew that you were going to quit if they didn't keep up. So she would get a raise, and she was making more than I was at the time. So we'd go out to dinner, and then I would get a raise, and I was making more than she was. So we would just tease each other about that. But that's how it was. And the psychology was, if you needed a TV set or refrigerator, new car, whatever, you say, I better buy it now because the price is going to be higher. If I wait a month or 2 months, the price is going to run away from me. So it had huge behavioral effects. Of course, gold was, going to the moon. There was a lot going on at the time. But Brian, you're right when you say we're putting up inflation numbers today that are the highest in 40 years. That is correct. A little 41. Actually, it was 1981 before we saw these numbers. But I remind people, the inflation in 1981 was the end of a 10-year period of inflation. It wasn't the beginning. It's like, oh, that's some inflation. Yeah, we did, but it had started. I mean, some ways it started in 1968, and it really took off in 1974, 75. So 81, these numbers, that was when Volcker finally got it under control. But you go back to 70, between 77 and 81, so that 5-year period, the dollar lost 50% of its purchasing power, not 15, 50 in that 5-year stretch. So you were putting up numbers, 10%, 11%, 13% and higher year after year. Yeah, 1981, it was 9 or 10, which is what they're comparing it to today. But that was on the downslope. It had been higher than that in 77, 78, and 79. So the question is this the beginning of an inflationary surge where it's going to get even worse and it is going to last 5 years? Or is it different than that? But keep that in mind, because the 40-year comparison, it is correct, but that was the tail end of an even worse episode. And again, there is this comparison to the 70s. By the way, I think the situation we're in today is very different from the 1970s, and I'll explain why. In the 70s, it was triggered from the supply side with first the Arab oil embargo in 1973 as a result of the 1973 Arab-Israeli war, and then the price tripled, but it went from like $2 to $6. Okay, but percentage terms that's a huge jump, but it was still $6, and then it got to 12, and then in 1979 you had a second oil embargo because of Iran and the Ayatollah and the revolution and the hostages and all that. And then it went from kind of 12 to 20. So oil went up by a factor of 10 in the course of the late 70s because of those two different embargoes. So that's coming from the supply side. But what happened was The other source of inflation is on the demand side. So you have what's called cost push inflation. That's where, you know, supply's choked off, or there's an embargo, or there's a shortage, natural disaster, a lot of things. It's coming from the supply side, and demand is inelastic, so you just pay up or, you know, kind of do without. But the demand side is much more psychological. That's called demand pull inflation. That's when consumers behave the way I described, and as I say, I lived through the 70s, where, you know, hey, I better buy it today, I better buy it now. You're pulling all this demand forward and bidding up prices because you're worried that it's going to get even worse. So as that applies to today, we are starting with the cost push inflation, you know, mainly the price of energy, but the price of food is a big factor. And of course, they're related. You know, it's like, here's the energy, here's the food. You know, where do you think the food comes from? To get the food, you got to feed the pigs and cows. What do you feed them? You feed them corn. How do you get corn? Well, you grow it on a farm. You need nitrogen fertilizer. You need diesel in your tractors. You get the food. You got to put it in a truck to get it from point A to point B. That requires diesel. The higher the diesel price, the higher the cost of food because you're moving it by truck, et cetera. So these things, as I say, are linked. But food prices are going up substantially, and the two things you can't do without are gas in the car and food. So you have that cost push inflation.
The thing I would point out is that there are bull markets and bear markets, and in basically any tradable instrument or commodity, or I consider gold to be a form of money. But what we're really talking about when we say, you know, gold is up, what we're talking about the dollar price of gold. And I view it as a cross exchange rate. People talk about the dollar, you know, the euro dollar exchange rate. Well, there's a dollar gold exchange rate, and that's the dollar price of gold. So they're just alternative forms of money where people get to express a liquidity preference or a credit preference, if you will, if you're concerned about if you're losing confidence in the dollar. But the first great bull market was 1971 to 1980. It lasted 9 years, and gold went up 2,200%. The second great bull market was from 1999 to 2011. Gold went up at just a little under 700%. But in between, you had a bear market from 1980 to 1999. It's a long one, you know, almost 20 years. Gold dropped from $800 to $250 at the bottom in 1999. And we had a second bear market starting in 2011. Now, I had a very interesting conversation with Jim Rogers. You know, Jim is one of the great commodity traders, money managers of all times. And we were down in Dominican Republic at Casa de Campo. This is around 2014, but, you know, the bear market started in 2011, but it really fell off a cliff in 2013. So I said, Jim, you know, what do you think of gold? What are you doing? He goes, well, I own it, of course. And he said, I'm not selling, but I'm not buying right here. And he said something that just hit me right between the eyes, and it stayed with me. And of course, he's right. He said, gold's going to the moon, but nothing goes to the moon without a 50% correction along the way. And if you look at the high in 2011, $1,900, you know, approximately, and where was the bottom of the bear market? It was $1,050 on December 16, 2015. Nobody knew it was the bottom at the time. But if you look at that drop down and you use $250 as your base, because, you know, you need a base. So you had basically the run from 250 to 1900 was $1,750. Go down 50% from there, it's $825. 1900 minus 825 is 1075, and the bottom was 1050. So Jim totally stuck the landing. Like at 1050, like, okay, there's your 50% retracement. Now that's the bottom. Now it's going up, and the sky's the limit. Well, we're not overheated at all. I mean, I've got gold at I would put it at $15,000 an ounce before 2025. But as I point out, if you're going to $15,000 an ounce, you got to get to 3,000, 5,000, and 7,000 first. So there's plenty of room to run, plenty of room for profits. But, you know, when I say things like that, I want to be clear. There's a lot of analysis behind it. I don't just pull a big number out of the air and, you know, for publicity, because I could care less. But if you just took the average, and there are a couple ways to think about it. Just take the average of the two prior bull markets I mentioned. So 71 to 80, 9 years, 2,200%. 99 to 2011, a 12-year bull market, about 700%. Just take the average. You don't have to go to the higher of the two or extrapolate. Just take the average of those two bull markets. You would say, okay, well, the next bull market is going to be a little over 10 years, and it's going to go up. It's going to go up 1,500%. So using that as your base, just take the average of the two. You say, all right, 10 years from 2015, that puts you out to 2025, and at 1,400%, it puts you at $15,000 an ounce off a 1050 base. So that's just history. But there are other ways to think about it. Now, I don't know if there'll be a gold standard or not, but I do know that gold will move. The price of gold will move in the direction of where it would need to be if you're going to have a gold standard. And I talked to Paul Volcker about this, and he agreed. If you just took the money supply, so just take M1, which is a pretty widely accepted definition of money supply. Take it for the U.S., the ECB, UK, Bank of Japan, and People's Bank of China. There are other entities you could include, but that's over 75% of global GDP right there. Divide that number by the official gold, which is about 34,000 metric tons, a little bit less, you come to $15,000 an ounce. So if you're going to either have a gold standard or even use gold as a reference point for money, if you need to restore confidence in the dollar, the implied non-deflationary price is $15,000 an ounce. So what I find interesting is that if you use just the history of the last two bull markets and average them, or if you use a rigorous calculation, what's the implied non-deflationary price? Interestingly, they come out in the same place. I don't think they have to. They're two different methods, but they both point to $15,000 an ounce sometime over the next 3 or 4 years. It is a moving target. The numbers I gave you were based on current levels, but if you keep printing money, you need a higher price if you want to reference gold and not cause deflation, which they don't. You're going to need a progressively higher price of gold. One thing people forget, they look at the dollar price in absolute dollars. So it went up $100 an ounce, or I expect before long it'll go up $1,000 an ounce a week. But each dollar increase is a smaller percentage increase. So people look at the dollar. Yeah, it's real money. It's nice to make the money. But if you go from $14,000 an ounce to $15,000 an ounce, that's only a 7% increase. I mean, you can do that in a week. So my point is, it's still $1,000 an ounce, good for the holders, but the percentage increase gets smaller and smaller as the absolute dollar amount gets larger and larger. So $15,000 sounds like a big number from today's perspective, but as you go to 10, 11, 12, it gets to be a progressively smaller percentage increase, and therefore more likely. You need to see it logarithmically to see it, a less hyperbolic curve. So logarithmically is the right way to think about it, but in dollar terms, the percentage increase gets to be pretty small at those levels. And when I say $15,000 an ounce, I don't think I'm stretching. I mean, could it be 25,000, 40,000? I mean, just take my monetary equivalent. If you use M2, and by the way, when I used M1 and did that math, that's with 40% backing, because historically 40% has been a high level of backing. If you take M2 at 100% backing, you get to 50,000 an ounce in a heartbeat. My numbers, I think, are conservative. They could be much higher. But the thing I would point out is that the Fed dug a hole and they can't get out of it. And I said all along, but certainly, 2014, 2015, et cetera, as they did the taper and then they did the liftoff and then they raised rates and all that. I said the Fed is trying to get out of this. They're trying to normalize the balance sheet, trying to normalize interest rates. But I also said they won't be able to do it. And that's exactly what happened in the fourth quarter of 2018. Between October 1st and December 24th, 2018, the stock market dropped 19%. It was 1 point away from a bear market at that stage. And then you had the Christmas Eve massacre. And that's when Jay Powell threw in the towel. He got religion. He said, okay, first he said, we're not going to raise rates anymore. Then he said, we're on pause. Then he said, we're actually going to cut rates. And then 9 months later, he said, we're going to end quantitative tightening, which was reducing the balance, the money supply. And then in September 2019, they started QE4, which is that was before before the recession, before the depression, before the pandemic. They were already in QE4 and cutting rates again. So they can't get out of it. Now it's worse. So they prove that the failure is manifest. They prove that they can't get out of it. And what can they do? By the way, on monetary theory, I mean, you say, what's the secret behind I think it's garbage, by the way, but you say, what's the secret behind it? Well, the secret behind it is if you can issue debt and collect taxes in the money that you print, you can force people to accept the money because they need the money to pay their taxes. And if they don't pay the taxes, they end up in jail. Now you can get extensions or do whatever, but at the end of the day, if you manifestly refuse to pay your taxes, they will come and put you in jail. And the point is, it relies on state power. It's really a neo-fascist concept. It relies on coercion, the point of a gun, jails, and state power to enforce the confidence in money. Now and they say that. I mean, I've read Stephanie Kelton. She's the bright light. I mean, this goes back a long way, but I've met her, read her books and her book, I should say, and her articles. But they're very explicit about that. Now, I think that's completely wrong because there's so many workarounds and so many ways to get out from under that kind of state power. But they do rely on state power at the end of the day. So that's why it has this neo-fascist element. Powell did not say, we're going to raise rates until core PC is 2%. He didn't say that. What he said was, we're going to raise rates until it's acting in a restrictive way on inflation, and inflation will come down on its own because rates will be high enough to cause that. At which point we the Fed will pause. And you say, well, when are you going to cut rates? He was like, the pause could be a year. So you're talking, forget this Fed pivot nonsense. I mean, you're talking 2024, if then, before they cut rates. But in the meantime, so they've got to get rates high enough. So they're going to go, 75 basis points in November. December, who knows? We'll know closer to the date. It'll either be 50 or 75. Some talk about 50, but it doesn't matter. I mean, it's going up. Probably going to go up. I have the calendar for 2023. There's a meeting February 1st and another one in late March, I think March 22nd. They'll probably raise at both of those. They're going to get rates up to five-ish. At that point, they probably will have achieved the goal of bringing core PCE down, but they will also have destroyed the economy in the process. It's like I remember in Vietnam, the old saying, we had to. This is the latest in a long string of Fed blunders since 1913. Seems to be their specialty, but that's what they're doing. They could at least pause now, or maybe even cut rates. If everything I said is correct, and obviously I think it is, or I wouldn't be saying it, but if we're on the verge of a global liquidity crisis, as revealed by the Eurodollar futures curve and the Treasury yield curve, and negative swap spreads and Treasury bill auctions with the yield to maturity below what the Fed will give you for a phone call, I mean, all those things are happening. That's hard data. And it's a very, very troubling sign, last seen in 2008, by the way, before the Lehman Brothers meltdown. If all that's happening and the fundamental signs are also weak, which we just saw in third quarter GDP, which is based on net exports, which won't last. How are you going to drive a trade surplus with the strongest dollar in 20 years? Good luck with that. I mean, nobody can afford our stuff, and we're not buying anybody else's stuff. So with the economy going into a recession on its own, with a global liquidity crisis brewing, why on earth is the Fed raising rates at all? When I talked to my editor about this, go back a year ago, so November 2021, every headline you looked at, website, commentators, supply chain's breaking down. There's no, they couldn't get cream cheese to make cheesecakes at Junior's, the world's most famous cheesecake place, and on and on and on, like a long list. And then last spring was the baby formula shortage, which was serious. I mean, mothers couldn't feed their children, so it was very bad. But I found some really, really interesting research that because everyone says, well, yeah, COVID messed it up and the war in Ukraine messed it up. Well, that's true, but it didn't start there. This started in 2018 with Trump's tariffs, because I'm not here to debate the tariffs. I actually think the tariffs were a good idea, but that was the start of the supply chain breakdown. Because when Trump put tariffs on, started with appliances, washing machines, refrigerators and stuff, and then solar panels, and then, technology, and then they just kept piling on. But you have to look at what China did in response. The U.S. and Brazil are the two largest exporters of soybeans. China is the world's largest importer of soybeans. Mm-hmm. China was buying all their soybeans from the United States just as a way to kind of make it up a little bit. Like, well, we got to buy the soybeans anyway. Why not buy them from the U.S. to keep the U.S.-China trade deficit under control so it doesn't become too politically toxic? Well, as soon as Trump threw on the tariffs, China retaliated by moving their soybean orders to Brazil, stopped buying U.S. soybeans. Well,
That's not a phone call. I mean, you're talking about vessels, port facilities, agriculture, trucks. How do you get the soybeans to the ports? How many do you grow? Where's the fertilizer coming from? Et cetera, et cetera. And all those parties, the shippers, the cargo, the insurance companies, there's so many people involved, banks, letters of credit, it's just a lot involved. They don't like short-term relationships. They say, okay, I'll do it. I want a 5-year contract. And China said, okay. So they reconfigured all those transportation lanes to get the soybeans from Brazil. All of a sudden, you're a U.S. soybean grower. You say, well, what do I do? Well, we started selling them to the Netherlands because the Netherlands needs soybeans too. So now instead of shipping them from like Port of LA to Ningbo and near Shanghai, we're shipping them from Port of Houston to, I don't know, France, in Marseille or someplace, or Rotterdam. So the point being, you completely scrambled all these supply chain relationship, and they break down. That it's not that it's the end of the supply chain. So there's nothing new about supply chains. We can document to the Bronze Age. What was new, beginning around 1989, was supply chain science. The combination of vastly improved computing power, artificial intelligence, new algorithms, and more sources of data that could be put together and used by experts to optimize and make the supply chains more efficient. That was new. And it kind of began with the fall of the Berlin Wall and the collapse of the Soviet Union. And, Berlin Wall fell in 1989, Soviet Union dissolved in 1991. I talked to the guy who, this is a worldwide endeavor, but he was probably the single most responsible individual for all the significant developments in the supply chain in the last 30 years. And he said to me, Jim, you have to understand, it took us 30 years to build it. We blew it up in 3 years. It's not going to come back overnight. It's going to take 10 years or more to rebuild it. And what I talk about in the book is supply chain 1.0, which is 1989 to 2019, and then supply chain 2.0, which kind of starts now, but is going to go indefinitely because it's going to take a long time to put this together. It's it's like dropping a vase and it breaks in 1,000 pieces. You can't put it back together. You got to go buy a new vase. And that's what's going on with the supply chain. There will be a supply chain, there always is, but the new supply chain will look very different from what we've just come through. Because the whole 30 years of period I'm describing was built on efficiency, lower cost, lower cost, lower cost. It was kind of the Walmart model. So yeah, just-in-time inventory, everyone knows about that, but there's something called cross-docking. That's where a truck pulls up at a warehouse and you unload it. Instead of putting the stuff in the warehouse, you move it to another truck that then goes to a destination. The stuff never goes in the warehouse. Inventories are very expensive. They're costly to finance. You got to move the stuff around. It's called picking. Pick the stuff off the shelf with you. I used to drive a forklift, so I know a little bit about it. And put it on a truck. I used to unload trucks too. So, hey, I've got 7 suppliers. Why don't I cut it down to 3 and do bigger contracts with each one and get lower unit costs? I've got 5 transportation lanes. Why don't I cut that down to 2, get everything to Los Angeles and Seattle, as the case may be, et cetera. And they did it for 30, and they got costs lower, and Walmart and Amazon were the champions of this, but everyone else was doing it. But they missed something. What they missed was that while they were getting those unit costs lower for consumers, there were hidden costs, and the main hidden cost was you were creating greater frailty. This whole system was subject to a massive, massive breakdown. So, what happens if you have 2 suppliers and they both go on strike? What happens if you have 1 port of entry and it's backlogged? What happens if you've got cross-docking in warehouses and there aren't enough trucks? We need 80,000 drivers. Wish they'd hire them instead of these IRS agents. But the point being, it is breaking down all across the board. Now, can it be put back together? Yes, but the biggest difference between 2.0 and 1.0, this goes by different names. Janet Yellen called it friendshoring, and Macron called it a constellation of nations. I use the term a college of nations, collegial club, if you will. So you'll still have trading partners, you'll still have outsourcing, you'll still have transportation lanes, but it'll be members only. It'll be basically democratic, kind of liberal republics, Western Europe, the EU, of course, US, Canada, Australia, New Zealand, Japan, and some others. India, I would expect to be included. Friendly nations, but China's out. We're decoupling from them. They're decoupling from us. This isn't U.S. driven. The U.S. is participating, but this is what China wants too. Both sides are decoupling as fast as they can. China can develop its own network, maybe Central Asian republics, some Southeast Asian, suppliers and so forth, but they're going to lose customers. Well, most of their customers actually in the United States. We won't buy their stuff and we won't sell them our stuff, particularly high-tech stuff. So the world's going to break, and these new clubs are going to be formed, and there will be trade and there will be transportation lanes, but it'll be much more restrictive. Now, will prices be a little higher? Yes, but it'll be more secure. So the way I describe that, if you buy insurance on your house, or I buy insurance on my house, you don't want your house to burn down. You hope it doesn't. But if it does, you don't think your insurance premiums are a waste of money. Like when you write that check, you're like, that's money well spent. When you pay higher prices for consumer goods, the delta between the old price and the new price is your insurance premium for a more reliable system. And also, there's a big national security component to this. It's going to get worse. Inflation's here to stay. Commodities are going to boom. Oil prices are going to soar. Bonds are going to crash. And gold has been in a very funny situation, which is the following. Normally, you say, well, if there's inflation coming, why isn't the price of gold going to the moon? And why on earth would gold prices go up if there were deflation or disinflation? The answer is that you have to look at the yield to maturity on the 10-year Treasury note. That's our benchmark security. A lot of people look at LIBOR, but I'm like, no. If you're making investment decisions, you're buying a house, you're doing capital investing, these are all 5, 10, sometimes 20-year decisions. The 10-year note is the right benchmark for those large, long-term investments. Well, that's an alternative place to put money. You can buy gold, you can buy a 10-year Treasury note. So what's been true since last summer is as the yield to maturity on the 10-year note goes up, that strengthens the dollar, and gold prices have gone down because the dollar price of gold is just another cross rate, just another cross exchange rate. So a stronger dollar means a lower dollar price for gold. But if the yield to maturity in the 10-year note goes down, then that weakens the dollar and the dollar price of gold goes up because a weaker dollar means a higher dollar price for gold. So curiously, the price of gold is being driven not by inflation in the abstract, but by the strength of the dollar, which is reciprocal to the interest rate on the 10-year Treasury notes. But here's what has changed. I talk about gold bull markets and gold bear markets, and I start my analysis in 1971, and I don't have to go through all that data, but that's how I think about it. And you're like, well, Jim, why 1971? Why not before that? And of course, 1971, it was when Nixon stopped redeeming dollars for gold. Americans couldn't even own gold in 1971. It was contraband. It was like drugs or machine guns or something. But foreign trading partners could redeem dollars for gold up until 1971. And then Nixon said no more. And then that was the final decoupling. But prior to that, gold was actually money. In other words, under Bretton Woods, gold was pegged at $35 an ounce. Prior to Bretton Woods, it was pegged at $20.67 an ounce. So going back to the 1920s or earlier, through most of the 19th century. For the United States in sterling, I think it was $4.75. It could be off a little bit on that, but four pounds and change. And as late as World War I, say 1913, if you were a Brit and you were getting on the steamer from London to, at the time Bombay, today Mumbai, you took a purse of British sovereigns. British sovereign is about 8 grams, a little bit less. It's not an ounce; it's a quarter ounce, because an ounce is almost too much. Even today, what are you going to do with a 1 ounce coin that's worth almost $2,000? You're not going to use that to buy a pack of gum. But in the day, there was the quarter ounce, which today would be, like a $500 bill. So it's still a significant amount of money. But you could get on the steamer in Southampton and get off in Bombay at the time, and it was money good. You could take that British sovereign and spend it anywhere. And same thing in Singapore and Hong Kong and Japan or all around the world. So gold was actually money. So it wasn't a question of, what's the exchange rate? It was, the gold was the money, and people thought about it by weight. They said, a sovereign, that's 8 grams of gold. So that's worth, that'll get you whatever. So, and that was true throughout history. And so it's really only since 1971, when we decoupled completely in terms of an exchange rate, that you have to think about, what's the dollar price of gold? Because it's not fixed. But okay, well, what happened to the memory? What happened to the 3,000 years I just talked about? Well, the answer is it happened in stages, and it actually took about 75 years. So it began in 1914. 1914 was the outbreak of World War I. Everybody needed gold. There was a run on gold, and countries needed gold because they knew they would need gold to pay for the war, to try to win the war. Well, it didn't matter if you're Germany, UK, or whoever. And remember, the United States was neutral. The United States did not get in the war until 1917. The war started in 1914. So for those first 2.5 years, New York was a money center to all of Europe, to all the belligerents. So everyone scrambled for gold. So if you were a citizen, they asked you to bring your gold to the bank, and they gave you paper money. But people did it out of a patriotic. It's existential. War's not a normal market. If you lose the war, you got bigger problems than your gold. And so people put the gold in the banks. What did the banks do? They melted it down and made 400-ounce bars. And they said, don't worry, your money's backed by the gold, but keep using that paper money, but it's redeemable for gold. But oh, by the way, they're 400-ounce bars. Nobody walks around with a 400-ounce bar in her purse. I'm sure you've seen one, and I have as well. They're heavy. They weigh about 35 pounds. You don't walk around with them. So all of a sudden, the gold was still there, and the paper money was backed by gold in theory, but the gold had disappeared into the banks. That's step one. Step two, and this happened in the 1930s, the central banks took the gold from the commercial banks. So first, the commercial banks took the gold from the people. Then the central banks took the gold from the commercial banks, and the Federal Reserve System told all the banks, hey, send your gold to the regional Federal Reserve Bank. And of course, most of it went to the Federal Reserve Bank in New York. So now it's not even in the banks anymore, right? But you're still walking around thinking your paper money is somehow attached to gold, but people haven't seen gold for a while, unless you're a collector. Step three, the United States Treasury and the finance ministries took it from the central bank. In 1934, the United States Treasury seized the gold of the Federal Reserve System. Bearing in mind, the Federal Reserve System is privately owned. And they gave them a gold certificate. And you go to the Federal Reserve System website today and hunt around a little bit on the links and find the balance sheet of the Federal Reserve, and it's there. And look in the assets. And the first line item is gold certificate, and it's valued at $11 billion. But that's because they value the gold at $42 an ounce. And I've revalued it, the answer is at today's market, that 11 billion is actually worth 470 billion. So the Fed has a hidden asset of 450 odd billion that's not on the balance sheet, represented by a gold certificate. But it's not the gold. The Treasury has the gold. And by the way, where do we keep our gold? I'm talking about the United States. The Treasury owns the gold. The Fed has a paper certificate. The gold is on two Army bases, West Point and Fort Knox. So I would say the Army has the gold. Gold has gone from citizens walking around having it in your purse, to commercial banks, to central banks, to finance ministries, held on an Army base. It's still there. The gold didn't disappear, but nobody talks about it, and everyone pretends it's not money. But of course it's money. But meanwhile, what's happened to the civilian population, the citizens? We stopped talking about it. We stopped saying it. We stopped learning about it. I remind people, just showing my age, but I got a graduate degree in international economics, and I was class of 74. But that was the year the IMF demonetized gold. But I was the last class that was taught gold in an academic setting as a monetary asset. If you're younger than I am and you know anything about gold, you're either self-taught or you went to mining college, because they just stopped teaching it. So now we have two generations of scholars who never learned a thing about gold. So they hid it, they took it, they buried it, they stopped teaching it, they stopped talking about it, and they pretended it's not there. Meanwhile, it is there. And Russia is a good example of someone who takes it seriously. In the US, we still have our 8,000 tons, 8,133 tons. We haven't given it away. We haven't sold any gold since 1980, by the way. We got the British to do it. We got everyone else to do our dirty work. The British sold more than half, the British sold more than half their gold. The Swiss sold 1,000 tons. The IMF sold 400 tons in 2010. That was the last significant sale by a monetary institution. Australia sold most of theirs. Canada sold most of theirs. If I were one of these other countries, I would say to the U.S., hey, why don't you sell some of your gold? But the U.S. doesn't. We haven't sold an ounce since 1980. I'd rather be the U.S. than China. China's in even worse shape for different reasons. It's not so much interest rate policy, although they're subject to global interest rate policy and exchange rates coming from the Fed. But you can see it in real estate. It's a full-scale collapse. They're propping it up, but the buyers aren't interested. In other words, the Chinese government is telling the banks to lend money to real estate developers who can't finish housing. Well, that sounds good. It's like, okay, here's some money, finish the housing. But the buyers are not flocking in. The buyers have been burned. They're shying away from that asset class. They want to increase cash. They're looking at other asset classes. They don't have a lot of choices because China has very strict capital controls. They're trying to get their money out by means legal and illegal. They're buying gold when they can. But as I say, they may not have a lot of choices, but even money in the bank looks pretty good compared to what's going on in real estate. The problem is too big. The bubble is too large. It's gone on for too long. We don't hear about it the same way we did about the Japanese real estate bubble in 1989, 1990. That was an epic crash. Japan is still not recovered. I remember in the 90s, early 2000s, they talked about the lost decade. Well, try 3 lost decades. That's going into a 4th. That's Japan. You know, 8 or I've lost count. Actually, 8 or 9 recessions since 1989. But it's really just one long depression. That's the way to understand the Japanese economy. China's going into something like that. We don't hear much about it because they're not transparent. They lie about their numbers. You need to look at private sources and use other analytic tools to understand what's going on there. But they've got drops in consumption, industrial output, real estate's collapsing. Their price indices are collapsing. All this fear of inflation. It's been around. It's real, but it's now turning around very quickly. And you can see that in China. China's going through something that the world has never seen. They're going to lose 600 million people in the next 50 to 70 years. This is a demographic implosion. This is worse than the Black Death. Of course, the Black Death killed somewhere between a third and half the population of Europe in the 14th century. It was a good time for labor, by the way. The labor was so scarce that returns to labor went up versus returns to capital because there weren't enough workers. But that's the only thing that can come close. Even the Spanish flu of 1919 killed about, no one's certain of the number, but between 100 million and maybe over 200 million people. The 30 Years' War was certainly, in the early 17th century, was certainly highly destructive. But what's going on in China now is worse than any of those things. It has to do with simple demographic math. The key number is 2.1. 2 people have to produce 2.1 children. Man and woman, or you can say per woman if you want, have to produce 2.1 children to keep the population constant. Why not 2? Why not 2 producing 2? The answer is infant mortality and those who don't make it to adulthood and can continue the repopulation of the planet, if you will. But they're not even close to that. They're well below 2. And by the way, so is the rest of the world. So is Australia and the US and Western Europe and a lot of other places. This is a global phenomenon, but it's particularly acute in China. It may be the case that China's replacement rate is or birth rate is actually 1. It has to be 2.1 to maintain. It could be 1 or lower. This is a demographic implosion unlike anything anyone's ever seen. It also has a dynamic. You can't reverse it very quickly. It feeds on itself, as I was talking about inflation earlier. So this is going to continue for 50 to 75 years. They're going to lose 600 million people. There are a lot of definitions of GDP, 4 or 5 part definition. There are more complex calculations, but there's one really simple definition. It only has 2 factors: population and productivity. How many people are working and how productive are they? That's nominal GDP. That's one definition of gross GDP or nominal GDP. Well, if your population is dropping from 1.4 billion to 800 million, you're losing 600 million people. And then what about productivity? Well, the other thing that's going on is China's population is aging very quickly. So you get a population of people in the 70s, 80s, and 90s with very large amounts of cognitive decline, dementia. Obviously, there's no productivity there, but it's worse than that because then you look at the shrinking population between the ages of 25 and 54. It's called that prime working age. More and more of those people are going to have to be involved in elder care. They're going to have to be basically caretakers or caregivers for the older population I described. A very worthy job, but not one that lends itself to productivity gains. Bathing hasn't changed in about 5,000 years. Robots don't do baths. The only real innovation in bathing in between 1870 and 1940, we did see the rise of indoor plumbing and hot water. That's good. I enjoy both, but that's it. I can't think of any other bathing innovations in the last several millennia. So if you have a shrinking working age population, a rising older population, high degree of cognitive decline, and a big slice of the working age population having to provide elder care or be caregivers for the older population, tell me where your industrial output's coming from. Tell me where your productivity is coming from. And sorry if I mentioned this already, but 50% of the water in China is poisoned because of, just their industrial practices. If you're a gold miner in Australia, I invest in gold mines around the world. I know that places like Canada, the US, and Australia, if you use cyanide to leach the gold, and that's a very common technique, you have to account for every microgram. Whatever you put in, you got to take out, weigh it, dispose of it properly. In China, they just dump it into the rivers, and so the rivers are poisoned. So China is an economic, demographic, industrial, moral, religious wasteland, and will suffer. It's already in a recession. Just to cut to the chase, again, they lie about their statistics. So here you have the two largest economies in the world, U.S. and China. U.S. is slowly going into what I expect will be a severe recession. China is in a century-long decline, unlike one that the world has ever seen. That could eventually lead to social unrest and a regime change, but let's not count on that in the short run. Just expect China to shrink and become more autarkic, decoupled from the Western world, and certainly not be a source of growth. Taiwan Semiconductor Manufacturing Company, the largest and most sophisticated semiconductor manufacturing in the world, and semiconductors are in everything. It's not just computers. There are 1,400 semiconductors in an automobile. There's a semiconductor or more in your dishwasher, your refrigerator, your washing machine. They're everywhere. Internet of Things. We all understand that. So TSMC, based in Taiwan. The United States has a military doctrine called the broken nest theory. And what it says is that if China, well, it comes from a Chinese proverb, ironically, and it says, if the nest is broken, how can the eggs survive? And what it means is that if China invades Taiwan, and I'm not forecasting an invasion, could happen though, we or the Taiwanese will very quickly destroy all the semiconductor manufacturers in Taiwan. We'll just blow them up. And China won't get anything. They'll have the broken nest. Taiwan Semiconductor knows this. They talk to the U.S. intelligence and military.
Yeah, that's a pretty good summary. I started my career as a lawyer in the late 70s, but before I went to law school, I got a graduate degree in international economics. So I have that, that macroeconomic background, if you will, even before law. And then after getting out of law school, I started my career as international tax counsel for Citibank. So that's about as broad a platform as you can have. And then along the way, switched into securities and derivatives law, worked for an investment bank, major dealer in U.S. government securities. That gave me a pretty good background in federal finance. And then switched to the hedge fund world and was there from start to finish at long-term capital management. Made a few headlines in 1998, and I was the principal negotiator of that rescue by, people say I was rescued by the Federal Reserve. That's not exactly right. The Federal Reserve did convene a meeting of the banks to organize the rescue, but said to the banks, you have to do this. They were sitting in the boardroom at the Fed, kind of hard to say no, but they adjourned over to Merrill Lynch's boardroom a few blocks away on Liberty Street, and we took it from there. And it was one of those deals, 5 days, no sleep, nobody's shaving. At first the jackets come off, then the ties come off, then the shirts are unbuttoned, and everyone's got a beard. Nobody slept, but we got it done, brought it in for a soft landing. After that, around an electronic stock exchange for a while, but was tapped by the CIA to help them with counter-terrorist finance after 9/11, and worked for them for 10 years. That's what we did. We invented a new branch of intelligence called MarkInt, for market intelligence, basically getting actionable intelligence
from capital markets information, which had never been done before. There's the INT stands for intelligence, so HUMINT is human intelligence, SIGINT is signals intelligence. We invented MARKINT, or market intelligence. That took on a life of its own, but along the way was just got literally a cold call from a top literary agent. She heard an interview I did on NPR's Planet Money. She's an NPR fan, and introduced herself and said, "How would you like to write a book?" And so I said, "I hadn't really thought about it, but let's talk." And we had lunch, hit it off, and then that led to book projects, and now 7 books, and 10 years later, here we are. So either you can either say I had an eclectic career, or I didn't what I wanted to be when I grew up, but I've done a little bit of everything from banking, capital markets, hedge funds, national security, intelligence, work with the Defense Department, and written a bunch of books.
Well, it's great to have you here. The first book, which came out 2011, was Currency Wars: The Making of the Next Global Crisis. And you certainly touch on a lot of currency dynamics, which are certainly prescient to what's going on today in the latest book, The New Great Depression here. When did you start writing this book? It's just come out in the past week, but it just seems so relevant and timely. I mean, you must have had some pretty fast turnaround on this thing, right?
We did. I got the call from my agent, my publisher, late April, and of course, then we were in the thick of the first wave of infections and fatalities, sadly, and quarantine and lockdown and all that. And the stock market had just dropped 30%, over 30% from February 24th to March 23rd. And so they said, we really want to book on this. It's really important. There's going to be huge interest in this. And can we do this? And I said, sure. And our original target date was July 15th. We were trying to come out on July 15th. And that's what we worked towards. So I said, so basically, given the target length and the outline, I was going to write it in about 40 days, 45 days. If you do 2,000 words a day, you can get there, but that's a lot of writing. So I said to my wife, well, there's good news, bad news. The bad news is for the next 30 days, I'm going to be the most antisocial person you ever met. The good news is we'll have a book behind us and we'll get that done. And that's pretty much what we did. I worked really hard straight through and kind of writing in the morning and reading at night, and almost like researching, doing the research at night, and then waking up the next morning and writing up the research and other observations. And it was all happening very quickly. I mean, obviously the disease was expanding, the economy was collapsing, but the amount of academic literature on the subject was, we're getting 10 papers a day coming from all over the place, and that was good, but it was an enormous amount. But when I first discussed it with my publisher, they said, well, Jim, we think you're great on the economy and capital markets and central banking, and all that's really important, and that's what we want you to write about. But keep away from the epidemiology and the immunology, because you're not a scientist, you're not a doctor. And I said, hold on, that's like asking someone to write about property damage in New Orleans in 2005 and not mention Hurricane Katrina. I said, you can't do that. You obviously, the pandemic is the catalyst or the cause of the depression, and you can't understand one without understanding the other. So I said, I'm going to do both. I teased her a little bit. I said, well, I do have 2 degrees from Johns Hopkins, so I'm not intimidated by natural science. I'm not a doctor, of course, but I'm comfortable in the field. And when I approached it, when I started doing the research, so by the way, Alex, this is the first book that deals with both the pandemic and what I call the new Great Depression or the economy. There will be lots of books written on the pandemic. Doctors have already written some. They're out there. There'll be books written on the economic crash and what's going on. Although it's a funny thing, economists actually don't write that many books. There are some, other than textbooks. Textbooks can be huge moneymakers, kind of boring, but there are a few economists who write books. Paul Krugman does, and Barry Eichengreen, and a few others. But generally, economists prefer to write
papers, journal articles, monographs, and things, because they're usually wrong and they're changing it. So you write a paper and you're wrong, well, just write another paper. Writing a book, you go out on a limb a little bit, because if it's going to have any kind of shelf life, you have to lean forward and do a little forecasting. And I have ways of doing that are better than what Wall Street and Washington do. But you're still you're out on the limb a little bit. But I'm comfortable, and I've done that before. But on the medical side of it, I read over 100 peer-reviewed journal articles. Obviously, top publications like The Lancet and the New England Journal of Medicine and others, but others that were top tier, maybe less well known, more specialized. But these papers were coming out left and right, and other evidence was coming out. And when I started doing the research, I said, well, this is going to be straightforward. There's a bunch of conspiracy theories and fringe theories and just wacky, speculation over here. And there's a lot of good science by reputable clinicians and PhDs over here, and just kind of discard this and focus on this. And that's what I did. But what I discovered, it was easy to discard the junk. But when I got into what I'll call real science, I discovered quickly that the scientists don't agree with each other. I can show you papers that say, you're a fool to go out without a mask. Masks are the key to this whole thing. Everybody mask up. That's the way we get a handle on the pandemic. I can show you other papers by equally qualified people, PhDs in virology and epidemiology, who say, no, masks don't work. The virus is too small. It goes through the weave. They're improperly constructed. We don't wear them correctly. And they don't do much good. It's kind of virtue signaling. And so, but my point is, without even taking sides in that, just as a writer, and I did present both views, and all that information is in the endnotes. The book has over 200 endnotes, and they're all fairly technical. So I tell people, if you don't like something I said, don't argue with me. Go to the footnotes or the endnotes and argue with the scientists. But I tried to, when there were divisions like that, I tried to represent both sides fairly. But I usually do come down on one side or the other based on my own view of the evidence. So that made it more challenging. And then you also have this whole, where did the virus come from? I have a chapter on that. Well, there's the wet market theory, which I thought last spring was a lie, basically Chinese propaganda. That's even more apparent today. You have the laboratory theory that it came from a laboratory, particularly the Wuhan Institute of Virology. Good evidence that was the case last spring. That's much stronger today. A ton of stuff has come in literally in the last couple of weeks, bearing that out. But that's how I came out in the book. I said it did come from the laboratory, but that's another area where, again, I can find top scientists with both points of view. I did learn in reading these scientific journal articles, there's always an abstract, that the authors, their affiliations, the abstract, and then the main paper. I would go right to the last page and look at who paid them, because they're, modern practices. You disclose your sources of research grant. If I saw you were paid by the Chinese, I discounted you about 50%. I might have included it, but I certainly took that into account.
We're seeing something globally we've never seen before, and it is the best single indicator of a recession. The last time we saw anything like this was 2007, just ahead of the 2008 financial catastrophe. So the stock market's saying it's all good. Goldilocks, soft landing. Fed's going to get the memo. They're going to cut rates, the pivot and buy stocks. The bond market is saying, no, this is bad and it's going to get worse, and it's actually too late for the Fed to do anything about it. But what happens is, as you get closer to the actual thing you're worried about, the inversion gets nearer and nearer. Now it is literally a month away, or less interest rates are a lagging indicator. Everyone's like, well, how could interest rates going up if we're in a recession? The answer is, as you get close to recession, who figures it out first? Well, the Fed figures it out last. They're usually the last to know. Wall Street is second last to know. The people who figure it out first are actual business people, entrepreneurs, restaurant owners, dry cleaners, taxi drivers, or even medium-sized businesses. They see it. A lot of business people are living in the real world, in real time. They know what's happening now, and the stock market tends to figure it out later. But as far as banking and credit is concerned, what happens is, if you're a business person and you see business heading down, fewer customers, whatever, you go out and borrow while you can. You're like, hey, this is a really bad recession coming. If I got lines of credit, I'm going to use them up. Now, I don't want my bank changing the terms. I don't want material average change clauses kicking in and said, I'm going to borrow everything I can. And that creates a demand for funds. And interest rates go up. And then the recession hits. And the bankers go, what's going on? Credit losses start going up. And then they just turn off the spigots and they raise standards. They stop doing loss. And then interest rates will start to come down. But interest rates peak after the recession has already begun. So stock market is telling us, Goldilocks, bond market's telling us, here comes Hurricane Mitch, or whatever. And then there's what I call the reality. What I see is kind of a hybrid. The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed is probably over-tightened. They're going to keep going for reasons I explained. That means they're going to make it worse. They're going to make the recession even worse. We've seen this movie before. This is exactly what happened in 2018. I don't know. Attention spans seem to be short these days, but it was not long ago. Go back and look at a chart, any stock index chart, from October 1st, 2018 to December 24, 2018. The stock market dropped 20%. I mean, it's like 19.9 or something on the Dow. So maybe not technically a bear market, but yeah, what's the difference? It dropped 20%, culminating in the Christmas Eve massacre, December 24th, 2018, when I think NASDAQ dropped like 3% in one day. Now here's the point. The Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre. And after most of the 20% collapse had already happened, they tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market. This whole Bernanke put and Greenspan put and all that, that's not how it works. They don't care that much about the stock market level. Here's what they do care about. They care about disorderly markets, and that's the keyword. Stocks are going down, but it's kind of 0.5% a day, 1% a day, trending down. Lower highs, lower lows trending down. The Fed doesn't care about that. They're not going to bail out the stock market. They do care if it's disorderly. When was it disorderly? Well, March 2020, at the worst part of the pandemic, it dropped like 30% in like 2 or 3 weeks. The fall of 2008. I mean, it was like somebody opened a trap door. The Fed does care about that because that kind of disorderly behavior can feed on itself and end up in a 1929 type scenario. So the Fed will get the memo, as I put it, stop raising rates and begin cuts when the markets are disorderly, but not just because they're going down. Now, here's what the Fed is missing, or maybe everybody's missing. When you hear these layoff announcements, people are like, well, if they're laying off, why isn't the unemployment rate going up? Unemployment lags the business cycle. Unemployment is a lagging indicator. When you're an employer entrepreneur and you're in any kind of not as many customers walking in the door, you'll do everything you can to avoid laying people off. Be late on the rent. You'll turn down the lights, find a cheaper laundry, whatever it takes. And then by the time you get around to firing people, you run out of options. I've done everything I can. Now my business is in jeopardy. I have to fire some people. And then combine that with what I just said about severance and rolling terminations, etc. It's a lagging indicator. We know enough right now to know that number is going up this spring, but that's not inconsistent with the fact that we're already in a recession. It's exactly what you would expect, that unemployment is a lagging indicator. Now, having said that, what else is the Fed missing? Well, wages are up 5% on annualized basis, 5.2% on annualized basis. I'm like, yeah, and inflation is 7% or 6%. So your real wage just went down 1 or 2 points because when the Bureau of Labor Statistics reports those wage numbers, those are nominal numbers. I'm not saying they're fake, but you have to know that they're nominal. And you have to subtract inflation to find out what's happening to real wages. And the answer is, real wages have been going down for a couple of years because it runs around 5% annualized, give or take. Sounds like 5% raise. What do you want? Well, yeah, but with 8, 9% inflation, or even 6% inflation, your real wage is going down. So that's not a robust number at all. By the way, the Fed wants to make it worse. The Fed agrees that those wage gains are too high. But my point is, in real terms, they're actually going down, but the Fed wants them to go down more. That would be one way to put it. If you get inflation down and wages are constant, then the real wage goes up relative to where it was before. But if you're unemployed, you have no wage. So that's another issue. Now, what the Fed is missing, and it's a long list, but there's something called the labor force participation rate. Now, the labor force participation rate, you just take the number of people working divided by the total working age population. That's all you do. It's not sophisticated. And that number today is around 61.2, give or take percent. But as recently as 2000, that number was over 70% and has come down ever since. And it dropped like a stone during 2020. During the pandemic, lockdown came back a little bit, but not much. The reason it got, first of all, it's never 100%. It shouldn't be. There are legitimate reasons to be working age population, not working. You're a homemaker. You're a student. There's a bunch of perfectly good reasons. So it's never 100%, not even close. But 70 is pretty high and 60 is pretty low, and the trend has been down. So that leaves relative to kind of a normalized number. That leaves about 8 to 10 million people between the ages of 25 and 54 who are not in the workforce. There's a big untapped labor pool. But if you took that group and threw it into the unemployment numbers the way the Bureau of Labor Statistics calculates it, unemployment would be about 9%. And that's the depression level of unemployment.
Notably in 1980 and 1981, regrettably, analysts anticipate that the recession will surpass expectations, with the bottom potentially falling lower than predicted, perhaps a 30% to 50% decline in the S&P, around 22,100. While we had a brief respite between 2020 and 2023, the situation is worsening in 2023 due to the concurrent financial crisis. The financial crisis is currently brewing, causing widespread panic. If it materializes, the impact will be severe, marking a dark day for America and the world. It's important to note that each financial crisis carries its unique level of impact, ranging from substantial to less significant losses. Predicting the scale and duration of a crisis is challenging, as evidenced by the subprime mortgage crisis from 2007 to 2008, which coincided with a recession, resulting in a disastrous outcome. The expansion of mortgage credit triggered this crisis, enabling widespread borrowing and mortgage acquisition. This mistake led to the collapse of the U.S. housing market, causing many to lose their homes, savings, and jobs. The repercussions extended globally given America's pivotal role in world trade. Discussions on recession, inflation, and deflation aside, one aspect yet to be addressed, referenced earlier, is the possibility of a global liquidity crisis. In 1998, despite the absence of a recession, the financial world faced a near collapse. Such crises can coincide with recessions, resulting in severe consequences. A notable instance is the subprime mortgage crisis from 2007 to 2008. There's speculation that 2023 might witness a collision between a financial crisis and recession, resembling the 2007-2008 scenario. Financial experts, including Jim Rickards, highlight signs indicating such a development. These signs include a diminishing world trade, daily declines in industrial output coupled with rising unemployment, and historically high interest rates for the past 15 years aimed at combating inflation but failing to curb inflated prices. If there are lingering doubts about the recession and financial crisis, examining the recent state of American banks provides clarity. In just a month, 5 major banks have faced setbacks, such as bankruptcy, FDIC takeovers, and collapses. The combined losses of credit and stockholders from these events surpass $200 billion, sending a clear signal of systemic issues. Efforts by the FDIC to reassure the public include unconventional measures, such as guaranteeing depositors sums exceeding $200 billion for Silicon Valley Bank and Signature Bank. These unprecedented actions, while seemingly noble, are predicted by Jim Rickards to deplete the FDIC insurance fund, ultimately affecting consumers. Moreover, the Federal Reserve's decision to extend more loans to member banks through the Bank Term Funding Program, BTFP, is causing significant turmoil in the U.S. banking system. These moves have intensified public anxiety, particularly among depositors. Concerns arise regarding whether these actions aim to implement new policies or if they are motivated by the interests of a few affected entities. The parallels to the 2008 crisis, where the FDIC guaranteed all bank deposits, echo in current events. As the government faces unrealized losses exceeding $700 billion in U.S. bank portfolios, the continued cash provision to depositors raises concerns about the sustainability of the banking system. The looming question is whether the crisis is truly over, or if the panic is just beginning. Drawing parallels with the 2008 financial crisis, which started a year and 6 months before reaching a critical stage. The current crisis, only a month old, has already led to the downfall of 5 banks. Addressing the broader economic situation, the FDIC's guaranteeing of all depositors and the Federal Reserve's offer of additional loans through BTFP signify pervasive issues. The Fed's guaranteeing of all bank deposits surpassing the $250,000 insurance limit echoes actions taken in 2008 to avert bank runs. However, such measures may strain the FDIC insurance fund with potential consequences for consumers. As the government grapples with increasing unrealized losses in U.S. bank portfolios, the fear is that continuous cash provision to depositors will hasten the collapse of the banking system. Despite attempts to reassure the public, it remains uncertain whether the crisis is truly averted. The interconnectedness of the banking system and the broader economy becomes evident, reflecting a situation that extends beyond individual instances. The Fed's unusual actions, coupled with the FDIC's extraordinary measures, intensify the prevalent challenges. Considering the gravity of the situation, the looming question is, what should one do? How does one respond to the panic and secure oneself against the impending crisis? While the inevitable cannot be avoided, taking proactive steps to preserve wealth becomes crucial. According to Jim Rickards, the first step is acquiring gold.
Down 20% in 3 months, getting close to crashing it. So what happens next? First week of January, Powell comes out, okay, we're not going to raise interest rates anymore. We're going to be patient. They use all these code words. We're going to be patient. Then he starts cutting rates. Then he starts QE, I forget if it was 8 or 9, whatever, lost track of QE. He starts QE 8, let's say. And then that takes you into 2020, and here comes the pandemic, and rates go down to 0, and the balance sheet goes to $7 trillion. They were back where they were in May of 2013. Except worse, because now the balance sheet was even bigger than it was then. A complete failure. So who thinks they're going to be more successful this time? They're doing the same thing. It's going to happen faster this time because the market saw that whole 7-year fiasco from May to 2013 to May 2020, a 7-year round trip failure. The same thing's going to happen, but it's going to happen faster this time because the market knows that the Fed doesn't know what they're doing. So the Fed's tightening into weakness. One of two things is going to happen, and it's not clear which, but it's going to be one or the other. They're going to keep tightening and keep tightening and keep tightening, try to get a handle on inflation and crash the stock market. Or they're going to lose their nerve, back off on the tightening, and then inflation is just going to rip, which will also crash the stock market. So take your pick, but it's going to be one or the other. But this idea of a soft landing is nonsense. The 2021 thesis was that, inflation grew. Part of it was base effects because, the way the government calculates inflation, it's monthly data compared to the year before. So it's year over year, monthly, then annualized. And so one could easily explain inflation in April, May, June 2021 because you were comparing it to 2020, which was the worst recession since 1946. But the base effects would run off in September, October, November. But the inflation persisted, even though the base effects were gone. So now it's like, okay, this is real inflation. It's coming from somewhere else. It was coming from the supply chain, which the Fed can't do anything about either because the Fed doesn't drill for oil. They don't build pipelines and they don't grow wheat. The Fed can't do anything about any of those things. And that's where the war and the sanctions and the continuation of COVID played a role. So, I say you can have your own views, but you can't have your own data. The data is clear. The inflation is here.
The renowned economist Jim Rickards continued her speech as follows. The supply chains are deteriorating, but these disruptions in the supply chain did not originate with the conflict. They didn't even commence with the pandemic. They initiated with the trade war led by Trump in 2018. I discovered an excellent book on this topic, authored by Luan Larocco. What's intriguing about her book is that she completed it in late 2019, serving almost as a control experiment. It predates the pandemic. It's convenient to attribute the disruption in the supply chain to the pandemic, which indeed played a role, and the conflict also had its impact. However, we have a meticulous examination of the supply chain's condition before either event, and the conclusion is, it was chaotic. It was chaotic back then due to tariffs on China and China redirecting soybean purchase orders from the United States to Brazil. That may seem straightforward because Brazil cultivates soybeans. Well, guess what? You have to transport the ships to Brazilian ports. You have to reorganize all the logistical lanes. That was already happening. The pandemic exacerbated it, and now the conflict exacerbates it even more. Yes, the world is fragmenting. We're disengaging, globalization is concluding. There will be a new iteration of it. It's not the termination of world trade, but you might witness perhaps the Five Eyes, UK, US, Canada, Australia, New Zealand, and allies in Western Europe forming a new trading bloc while excluding China and Russia. It will resemble somewhat the Cold War. I discussed this with Paul B. However, in the 70s, something similar occurred. It commenced with cost-push inflation. It was the Arab oil embargo in 1973 after the Israel-Arab War. Then the Arabs imposed the embargo on us, quadrupling the price of oil from $3 a barrel to $12 a barrel. It might sound inexpensive, but that's a 300% increase. Subsequently, we experienced a severe stock market crash and recession in 1974, the most severe since the Great Depression at that time. We've encountered more severe ones since, but back then it was the worst recession since the Great Depression. Following that, the Fed intervened and Nixon abandoned the gold standard. Nixon implemented an accommodating monetary policy in '72, a bit earlier for his re-election effort, etc. So, here comes inflation, but along the way, and then there was another oil embargo, actually an Iranian oil embargo in 1979 after the Ayatollah took over. So there were dual oil shocks. It was a supply-driven cost-push inflation. However, it transformed into demand pull. It evolved into a demand-side scenario that I lived through. I was a young, up-and-coming lawyer at Citibank, a senior officer living in New York City. That was a time when if you desired anything new, furniture, TV set, vacation, anything, you rushed out. You dropped everything, rushed out, and did it because the price was escalating so rapidly. This is instructive in two ways. Firstly, it illustrates that the Fed is consistently behind the curve. It shows that these issues can persist much longer than anticipated. But more crucially, because I believe things will happen more swiftly now, it demonstrates inflation shifting from cost push to demand pull, transitioning from a supply-side matter to a psychological shift on the consumer side. Volcker managed to suppress it, but at a substantial cost. Unemployment reached approximately 11%. He elevated interest rates to 20%. How does that feel? Mortgage holders, student loan holders, and others? 20%. We're talking about 40% on credit cards in that era. People tend to forget, well, doesn't inflation mean you have high growth or whatever? At least low unemployment. No, we had stagflation. We had inflation and high unemployment. There were 3 recessions between 1974 and 1982. We experienced 3 in 1974, 1980, and 1981, which persisted until 1982. By the way, people lost confidence in the dollar in the late 70s. Jimmy Carter's Treasury issued what they call Carter bonds. The U.S. Treasury issued debt in Swiss francs. Now it was Treasury.
Slowing industrial output, slowing retail sales, and importantly, for investors, a very sharp decline in inflation. So this is one of the kind of mystifying points about the U.S. stock market. I mean, it seems straightforward to me, but the market has their own dynamic. They're saying, well, if the Fed raises rates the way I described and they cause a recession, the Fed's going to have to cut rates. That's called the pivot, the Fed pivot, and lower rates are good for tech stocks, so buy stocks. But think about that for a second. What if inflation comes down faster than the Fed thinks? And I think it may, by the way, I'll return to that. What if inflation comes down really fast and they get to the target rate sooner than they think? Does that mean they might have to cut? Well, it might, but what's good about that for stocks? I mean, if that happens, no one ever says, why did that happen? They just say, well, inflation may come down, interest rates may come down, so buy stocks. It's like, well, inflation may come down, interest rates may come down, but if it does, it's because we're in a very severe recession, exactly what I'm forecasting. And so if that's the case, stocks are going to plunge, 30, 40, 50%. So don't root for lower rates, or if you're forecasting lower rates, understand what that means. It doesn't mean the Fed chickened out. It doesn't mean life is wonderful and you should buy tech stocks. It means that we're in the very severe recession that I described, and I think we will end up there. And therefore, stocks are going to plunge. So, be careful what you wish for, as they say. My forecast is, yeah, they are going to raise rates. They're going to over-tighten. They're going to cause a very severe recession. And when they do, they may pivot at that time, but it won't be for good reasons. It'll be for very bad reasons, meaning we're in a recession and stocks have plunged. So don't buy into the Wall Street chatter as far as that's concerned, because as I say, the Fed's going to over tighten.
Now, why isn't the Federal Reserve aware of this? Well, because they never are. because they have the poorest forecasting record of any institution I can think of. Their entire history since 1913 is one mistake after another, and this will just be the latest in the long series. So, just to kind of recap, the Fed is on a trajectory. We know precisely what it is because they informed us. All you have to do is listen to them and believe them. They're going to increase rates, let high rates do their work, and observe the inflation come down, and maybe in 2024 decrease rates. What I anticipate is they are going to raise rates for the next couple of meetings exactly as I've outlined, but they're going to over-tighten. The signs of recession are already present. The Fed's not looking at them. I'll come back to what they are, by the way. And we'll be in a very severe recession for a lot of reasons. And that's going to mean a plunge in stock prices. So if the Fed cuts rates, don't cheer too loudly, because it'll be in a world where severe recession, higher unemployment, and crashing stock prices are the norm. I'd like to conclude on, I can't call it a joyful note, but a global liquidity crisis. Now, I talked about a global recession, and people go, well, isn't that like a liquidity crisis? No, a recession or a depression is very different than a liquidity crisis or a financial panic. They're two different things. They can and do happen separately. In 2008, we had both. In 2008, the recession or depression and a financial panic converged, so they can happen together, but they don't have to. They can happen individually. What we're in for visually looks like a global financial crisis and a global recession at the same time, coming sooner than later. Now, why do I say that? There's a global dollar shortage. People go, wait a second. The Fed printed $9 trillion, which they did in 2020. It's come down since then, but they did print that much money. How could there be a global dollar shortage? What people don't understand is that behind the curtain off-balance sheet, this is off-balance sheet. You've got to go read the footnotes and understand what you're reading. There are $1 quadrillion of derivatives. And for those not familiar with quadrillion, 1 quadrillion is 1,000 trillion. So, I just said the Fed printed $9 trillion. Maybe it's down to 7 trillion, but you have $1 quadrillion of derivatives, and they have to be supported with collateral. Not 100%, not even 10%. I mean 1% or 2% is enough. But when you're in a liquidity crisis, banks are extremely choosy about which collateral they'll accept to support this $1 quadrillion inverted pyramid of derivatives. And right now what they're saying, because this evolves, it gets worse. It doesn't happen overnight. It can become acute overnight, but it happens over the course of a year or longer. What we see, the banks are saying, I don't want corporate bonds as collateral. I don't want your mortgages as collateral. I don't even want 10-year treasuries as collateral. The only collateral I want are short-term U.S. Treasury bills. Treasury bills have a maximum maturity of 1 year, 360 days, but there can be 4-week bills, 8-week bills, 6-month bills, etc. That's the best form of collateral. It's the most liquid, easily traded, low volatility, easy to repledge, is by far the best form of collateral. That's all the banks want right now. But if you're a foreign bank, you need dollars to buy the dollar-based collateral. If you want treasury bills that are denominated in dollars, you need dollars to buy the bills. That's why the US dollar is so strong. People go, wait a second, the US has a multi-trillion-dollar annual budget deficit, a massive trade deficit, 132% debt to GDP ratio, $31 trillion in debt. You're going into a recession. How can the dollar be so strong? The answer is everything I just said has nothing to do with the demand for dollars in international foreign exchange markets.